Okay. Hello. My name is Yemi Legushe, and for this afternoon, I want to talk about the difference between mortgage life insurance and personal life insurance. Or let's say I want to compare mortgage life insurance versus personal life insurance so that you can make an informed decision. I need you to be able to make an informed decision because you can actually use your personal life insurance as your mortgage life insurance. So you need to know what mortgage life insurance offers or the benefit that mortgage life insurance offers to you. Now the question is, who do you want to protect? Do you want to protect the mortgage lender or do you want to protect your family? Because the mortgage life insurance is going to protect the lender. Your personal life insurance is going to protect your loved ones. Now, I am going to explain mortgage life insurance. Mortgage life insurance is an optional product that pays the balance on your mortgage to the lender. God forbid death happens. That is, you gain admission to heaven, right? Mortgage life insurance is an optional product that pays the balance on your mortgage to the lender. God forbid you gain admission to heaven. Take note, you have bought a property of $1 million, $500,000, and you set up a contract of 25 years amortization period. If life happens during that amortization period, you are still owing the lender a certain amount of money, and the lender needs their money back. So mortgage life insurance makes sure that if life happens during the amortization period, the mortgage lender gets the outstanding debt, right? So that is what mortgage life insurance does, so that your family members living in the house do not need to struggle paying off that mortgage. So you are doing a lot of service, and you're doing a lot of service to yourself and to your family by setting up mortgage life insurance. But the good thing is there is something better in terms of you can use your personal life insurance as your mortgage life insurance. So I have to explain some terminologies here. When you want to buy a property, you need down payment. Depending on the value of the house, that will determine the down payment that is legally allowed, right? If your the purchase of the house is 500,000, then you need minimum 5% down payment. If you want to buy a property that is between 500 to 1 million, for the first 500, 5% down payment. For anything above the 500, at least 10% down payment is required. But any property that is 1.5 million and above, you need minimum 20% down payment. There was an error on this slide, okay? So mortgage default insurance, there is this error right here. It should be 20%. That's an error. So mortgage default insurance is the same as mortgage loan insurance. It means if you if you have a down payment that is less than 20%, right, you will need to set up mortgage default insurance. It is also called mortgage loan insurance just because your down payment is less than 20%. So it comes to you as an extra cost. The companies that offer mortgage default insurance or mortgage loan insurance, we have three companies in Canada, CMHC and Sagen, and CMHC, Sagen, and Canada Guarantee. Okay, those three companies are the only companies that offer mortgage default insurance, and the percentage of people that buy properties with less than 20% is high. So it is something that it's a plan that people will always set up. So these are the companies that offer mortgage default insurance or mortgage loan insurance. Now, mortgage default insurance or mortgage loan insurance is different from mortgage life insurance. Okay, it's totally different, right? The mortgage loan insurance, this one is compulsory, very compulsory. So far your down payment is less than 20%, there is nothing you can do. It is either added to your monthly mortgage bill. But you see, this mortgage life insurance, it is good, but you can actually have something better and have value for your money. Now, what is the major difference between a mortgage life insurance and your personal life insurance? The mortgage life insurance, the benefit goes to the lender, and then your personal life insurance, the benefit goes to your beneficiary. And that beneficiary, whoever it is, your spouse, your kids, they can take that money and pay off the mortgage. they will most likely have something left over. The coverage of your mortgage life insurance decreases. So, for example, if you have a property of $800,000, your mortgage life insurance is also $800,000 because that is what you owe the lender. After 10 years, you have been able to pay the mortgage consistently for 10 years. And now let's assume the outstanding mortgage debt is just 580. Because it is 580 that you owe the lender, that is what is going to reflect on the mortgage life insurance because that is what you owe the lender. God forbid life happens and you gain admission to heaven, right? But when you have your personal life insurance, you have 800,000 if that is the policy you set up, right? Even 10 years after, it is still $800,000 except you changed it. Okay, the purpose of your mortgage life insurance is to pay off your mortgage back to the person that gave you money to buy that property, which is the mortgage lender. That is the purpose of the mortgage life insurance. And that is why the benefit goes to the lender. But your personal life insurance, the benefit goes to your family and they can use it to pay off all other debts like mortgage, kids' education, credit card debt, and stuff like that. Now, mortgage life insurance is usually tied to the lender. Right. For your personal life insurance, it depends on the type of policy you have. You might be able to upgrade it, you might be able to convert the term to permanent. So it all depends on the type of personal life insurance that you have. Now, the most important thing is I've asked you a question. Do you want to protect the lender? That is, if you have mortgage life insurance, or do you want to protect your family? Because you see, these policies, they do the same thing. You are protecting a property financially. If life happens, yes, the mortgage lender gets their outstanding debt. So your family is not bothered about mortgage. But if you have your personal life insurance and your main beneficiaries, your loved ones, your beneficiaries receive the death benefit tax free. They can use that amount of money to pay off the lender and they might still have some leftovers, right? They might still have some extras left behind. That is why your life insurance should be properly designed by someone that can educate you about the current benefit and then the future benefit. Some examples are here. Your mortgage life insurance is based on the mortgage value. The benefit decreases with time and the benefit is paid to the lender. Your family do not receive $0. So if Jane Doe sets up mortgage life insurance of 1 million, the mortgage lender is the beneficiary during that amortization period, right? After 5 years, she owes just $800,000 on that property. It is $800,000 benefit that is paid to the mortgage lender because that is what she owes the mortgage lender. Okay, and types of life insurance in Canada, it is not one size fits all. Okay, we have term insurance, very affordable, depending on the term period. If it is term 10, it expires after 10 years. If it is term 15, it expires after 15 years. And if it is term 20, it expires after 20 years. And you are need to renew it if you want to renew it. Renewal comes at a higher cost because you are 10 years older, 15 years older, or you are 20 years older. Universal life is a type of permanent life insurance that combines life insurance with an investment account. You are able to use the investment account once it has accumulated. And guess what? You should work with an experienced professional to set up this type of policy because there are so many factors that needs to be considered. You have to fund the policy very well so that it doesn't terminate. Investment must also be monitored yearly. For whole life, it has a fantastic benefit of guarantee. It offers some form of guarantee, but it's the most expensive life insurance. So, guess what? The most important thing to you is you want to set up life insurance because of the benefit. You can use your life insurance as your mortgage life insurance. You can get compassionate benefits from your life insurance. God forbid you are diagnosed with a terminal illness. Then usually, I advise my clients combine term insurance and permanent life insurance. Life might be long or short. You want a policy that it is still very much in use, even though you are 70 or 80 or 90. a policy that can actually pay you compassionate benefit. God forbid there's a terminal illness, a policy that you can actually enjoy living benefit from the policy even though you are 65 or 70, right? So it is actually good if you can combine term insurance and permanent life insurance. Now, do not be confused about social media. If some people say term insurance is bad, whole life is so if term insurance is good, some people might just tell you that term insurance is good, whole life is bad, universal life is terrible. Those type of people, they only have like their license can only offer you term insurance. So you need to work with someone like myself that can explain term insurance, whole life, universal life, that can educate you about the benefits, about the clauses. Each of these policies have clauses that you have to be aware of. And then you as the client, you can decide the type of life insurance that you want to set up based on your risk tolerance and your budget. Okay, a fully funded universal life of 1 million in the first year will always be 1 million so far you have well funded the policy. Even at age 100, yeah, the 1 million tax free benefit can be paid out to your beneficiaries, right? Whole life, if it is well funded, right, and you have a 1 million life insurance, it's going to be based on your budget. Can you afford it? It will always remain 1 million tax free benefit if it is well funded. If it is well funded. So 10, for example, is a good life insurance if your budget offers that option, right? But you need to renew it every 10 years. If you set up 10, 20 life insurance, you have to renew it every 20 years, right? And it's not the same amount every 20 years. If it is a 10-10, then the premium goes up every 20 years. So if you have a 10-20 or 10-30, you can actually use it for your mortgage life insurance, because for your personal term insurance or whole life or universal life, the benefit goes to your beneficiaries that you name on the policy. For your mortgage life insurance, the benefit goes to the mortgage lender. But you can use your personal life insurance, whether term or whole life or universal life, you can use it as your mortgage life insurance. You can use it as your mortgage life insurance. Yes. And I hope you learned something today. Thank you so much for allowing me to share. Have a wonderful afternoon. Let me know if you have questions and I'll be able to get you started on that journey. Feel free to reach out if you have questions and have a wonderful afternoon. Thank you very much.